Folks, thanks very much for tuning in. Hedley Widdop here, Managing Director from Lion Selection Group, in Melbourne-based mining investor, and I'm sitting here talking to Ian Bamborough from Saturn Metals, which is one of our largest investments. And Ian, we really enjoy working with you. I got a couple of questions for you. First one is, you have one of the lowest grade gold resources getting around, yet it's very large, and in the studies that you've released, it produces a hell of a lot of value. So many people stick to the adage of grade is king. Can you tell me why it is that you can create immense value from low grade against that adage in the background?
Margin. So I think margin is the answer, but it goes beyond that. It's margin and then the volume at which we're treating this deposit. So if we look at our margin, what are our margin drivers in the first instance? Very low strip ratio, 1.5 to 1 in our preliminary economic assessment. Our block size, 10 metres bench height, 20 metres wide. The big difference is there much lower unit mining costs, which are driven by the bigger equipment, and literally one gentleman sat in a digger moving the levers X number of times a day is more, if it's a 60, 70 ton face shovel, is 6 or 7 times more efficient than a 10 ton face shovel. So, and wage has been a big cost. Very efficient, clean metallurgy. I think Apollo Hill is one of the nicest, cleanest metallurgies I've ever seen. Low reagent use, no preg-robbing materials. The gold's easily beneficiated. And because of its size and where it sits in the particular mineralogy, easily leached at very low cost. So all those things keep pushing that cost base down. So the difference between the revenue you get per ton and the cost is actually pretty respectable. And quite often, in a lot of instances, as big or if not bigger than some of the higher grade deposits, which is where people are traditionally taught to focus. These type of deposits you look at Round Mountain in the US or Bald Mountain, Kinross mines. They're probably some of the biggest, most efficient and profitable mines in the world. So we're really embracing the cost structure of this particular asset. And then I always remember, doing my MBA, one of the best businesses in the world are usually the ones that have big volume times small margins. And what we have here is a very respectable margin and then big volume. And that's where the leverage comes. So, tons times revenue per ton actually equals some quite impressive free cash flows on a per annum basis.
And what are we talking here? I mean, when we talk about efficiencies, you've got to multiply it over a lot of ounces for efficiencies to add up. But what are we talking in terms of what the scoping study said to move a ton, extract the gold from it, the revenue that gives you, and the margin that gives you, multiplied by what?
Yeah, so I think, our processing cost is probably about $11.92. I think if I've got my number right to the cent. Typically in our region to process a ton of ore, we might be looking at $17.50, $18.50 on that kind of West Australian environment. So that's the big shift. You might be looking at $5.50 a ton to move in a typical Archean low gold deposit from a mining perspective. In RPA, we've scheduled about $4.50, and we were actually being criticised for it being too expensive. But if that's the fact, great, I'll take that. That's perhaps a credit for the future.
It's a lot lower than in comparison to everybody else. Yep.
And I think in summary, the sort of maths that's the most convincing for me is if you think, at these kind of gold prices, we might be looking at, well, even well below the current gold price, $66 a ton revenue, for example, on our ore, times a recovery of 75% on a heap leach pad, which we've arguably been a little bit conservative with again. That's $48 a ton. So 48, there's a nice little equation here. My all-in sustaining cost is about $24 a ton. So 48 minus 24 equals 24. So nice round numbers to remember. And that's a nice margin. But then the kicker is times 10 million tonnes per annum equals $240 million free cash flow. And with a capital efficiency of the heap leach, when we're looking at a sort of 304 million pre-operational capex build, you can see that you start to see a rapid payback, B, strategic size ounces and cash flow. And I think, if you looked at some of the gold producers in the gold fields at the moment from multiple assets, it really sets Apollo Hill as that strategic sized asset. And I think an important asset on a global scale, not just an Australian scale.
That makes great sense to me, and I'm feeling much more comfortable having put the money in now. So next question for you. You've talked a little bit in some of your public disclosures about a pilot facility. Typically gold projects don't have a pilot stage, but it might make sense for you to use it. Can you just explain briefly what that would be? But then furthermore, what does that generate for you by way of a technical understanding, and where could that lead in terms of opportunities? And I mean, I know we're early stage in this conversation, so there's a bit of arm waving to go with it, but just, can you sell the concept so that we can have a think about, why would you do the pilot facility, and could that accelerate you, or does it just tick some technical boxes like PFS studies normally do?
Yeah, look, I think piloting is usually done in some of the more complex industries like rare earths, for example, or perhaps even uranium, that kind of thing. I don't think we're doing it here because of that. Heap leaching it's probably 50% of the world's gold production annually. It's not new technology. This is very conventional gold extraction technology. So it's not necessarily from that perspective. There's several reasons. One, it can technically inform a definitive feasibility and replace some of our metallurgical test work. We're doing that at full scale, and if we do that at full scale, I think it could be an important part of our project financing journey, from de-risking in terms of talking to banks or lenders, and bringing those people on the journey with us as we look to finance the big project, which is the ultimate prize. I think from another aspect, it informs the environmental permitting, or to actually we're permitting the pilot at the moment, and to do that we've had to really do a lot of work for the big project, which is, to my mind, accelerated the pre-feasibility and definitive feasibility stages. So there's those. The thing I do like is it's a lower capital startup, or potentially a lower capital startup for the company.
Yep.
And that, to me, and if we do it right, and if we're going to do it, we're going to make sure we're going to do it right. So, this is still subject to ticking the technical boxes, all the permits, authorities, financial investment decision, but we're definitely on that journey now. It could even make some money and not just become part of our capital journey in terms of informing our bankable feasibility or informing our financing discussions, but actually, and particularly depending on how we fund this, be part of our cash journey into full-scale production.
I think that's really interesting, because a lot of the market looks at gold hopefuls at the moment, and it says, well, on a standard template, you have a big deposit, you need to raise a lot of money, there'll be a lot of equity in that, so there's a big dilution piece.
Yep.
I just reckon if you can take a step forward, and if there's 10 steps to being at that full scale, it sounds to me like that pilot facility could be 1, 2, maybe even 3 of them, in terms of pushing aside some of the blockages. But if you're in business at a smaller scale, I suspect you could be rewarded for that. So that's an exciting outlook to me.
Absolutely. I mean, the capital for the big project, 300 million, this project is a tenth of the scale of our annual production. So rule of thumb, your capital might be a tenth of that. So maybe it's 30 million. Now that is well within, I think, the reach of a business of our size. And I think is an important first step. The way we are designing this is we're really trying to find not a step into the next stage of production or production size to get to the File 1. It's a smooth transition and journey, and that's what we're modelling. But you've got to take that important first step.
Yep.
So, and if you can do it at a lower capital, potentially less dilution, you from a company perspective, we develop our own capacity. It's people.
Yep.
Is very important, and developing our people and bringing them on a journey so that when we get to full-scale production and the prize here at Paula Hill, we have a trained, competent workforce that we brought along with us, and it's a little bit walk before you can run approach.
You've got the operational readiness potentially under control.
Yeah. Absolutely.
Well, look, Ian, it's the largest investment that Lion's made. So far, it's also the best performer that we've got in our portfolio. We're all really wrapped with that, and it's terrific working with you from a Lion perspective. So we're looking forward to what 2025 holds, seeing which way you decide to go, and hopefully seeing that pilot facility come to fruition and get explained to the market, and then onwards and upwards to the bigger project. So all the best as we go forwards there, mate. Well done.
Yeah, no, thank you, and thanks for Lion's support, and happy Christmas. We're not that far away.
Exactly. Yeah, happy Christmas. Yeah.
Yeah.
Hopefully we'll get some gold for it one day for Christmas.
Yep. Thanks very much, Adam.